fundsupermart.com.
European equities have turned out to be one of the best performers in 2013. With us today is Mr. Jonathan Allison, Investment Manager of Pan-European Equities of Aberdeen Asset Management, who will share with us Europe's investment outlook in the coming year. Hi Jonathan, thanks for joining us. Recent growth data suggests that Europe's economic recovery remains fragile. What is your outlook for the Eurozone in 2014?
Well, if you look at IMF forecasts for European GDP growth, they're pitching it at around 1.5% for 2014. And some of the other commentators are sort of hovering in that sort of 1 to 1.5% level as well. So growth is positive again, and that's good, but it needs to be borne in context of with the rest of the world. It's an absolutely low growth rate, and compared to other parts of the world, certainly still quite a bit below. But it's good to see that things are improving. There's been a lot of improvement among some of the peripheral countries in Europe. Greece has made some good moves. It still has a long way to go, but it's set to return to growth in 2014. Spain has taken some quite bitter medicine, if you like, on the structural reform front. It's probably beaten consensus expectations more than any other major area in the Eurozone. So that's good to see. But then you have core countries like France, for instance, which have slipped into recession in the third quarter of last year. And Italy as well has faced 9 quarters of consecutive recession. So it would be best described as a patchy, fairly tentative recovery in Europe, and we're still very aware of the risks.
What is your view on the valuations of European equities? Are they expensive or still attractive?
If you look at European valuations, they're certainly not as rock bottom cheap as they were perhaps 2 years ago. Trading on around 13.5 times forward earnings now for the MSCI Europe index. Those valuations are okay. That's an okay valuation multiple. And it's okay in the context of earnings growth, which is some way behind peak levels. So there's potential for valuations to move higher, share prices to move higher, but we really need to see earnings actually drive that performance. A lot of the recovery in share prices has been driven by a re-rating in 2013, and it's difficult to know how much more of that there is still to go, but it's certainly earnings that need to start doing the hard work from here on out.
There are concerns over easing inflation in Europe, which may bring about higher deflation risk. How will this affect the investment environment?
Yeah, deflation in Europe and the risks of deflation in Europe is something we need to be aware of as investors. Everybody talks about Fed tapering and the effect that might have on emerging markets, and perhaps if some time down the line, that started to feed through into higher rates in Europe, what effect that might have on more highly leveraged European countries, perhaps in the periphery. But I think the more immediate risks in Europe are actually on the deflationary side, both from a supply side and a demand side point of view. Whereas the ECB balance sheet has expanded and grown, you find that a lot of the banks themselves have actually been more cautious with their capital and have not lent out to consumers, to small and medium-sized enterprises. And that's restrained the amount of capital flowing into the economy. And the other thing is, from the consumers and corporates' point of view, sentiment has been quite low. Consumers have been paying down their own debt, whether it's high credit card balances or paying down their mortgages on their homes. Corporates have also not had a huge demand for new loans because they've been a bit cautious on how quickly to expand and when to invest in this more difficult economic environment. So there hasn't been this sort of demand pull either. And what we find in the economy is there's still quite a lot of spare capacity, especially in the peripheral countries within the Eurozone. And the last thing to add is that wage inflation is quite low as well, and commodity inflation is quite low. So these are also the potential deflationary headwinds, if you like.
In the coming year, what are the sectors or asset classes that you see investment opportunities?
So our approach at Aberdeen is always to go one step back from that and look at the companies themselves. So that's always the starting point for us. We don't look at what particular economic or macroeconomic event might act as a catalyst for a particular country or particular sector to do well. You know, we look at companies, and if we like a company, we like its business model, and we like its competitive advantages, it could be in any sector, and you know, it might still be an attractive investment for us. Just to add a bit of color, what we've found in terms of sector performance over the year is a lot of sectors that have quite high exposure to emerging markets have underperformed, and we find some good companies within those sectors. Consumer goods, for instance. A lot of the commodity-related sectors have been weak, and again, there's good businesses within that area that are trading on attractive valuations now. And some of the industrial companies, some of the good engineering businesses, some of the good mining and oil and gas services companies, again, because of their exposure to commodities, have been weak in 2013 and have actually lagged the recovery. And we see good value in some of those very high quality businesses too.